Essentially, there are 7 points that I would like to cover during the course of the next 50 minutes or so. First of all, a general introduction on Labuan, and I appreciate that as a Malaysian audience, you're probably already pretty familiar with Labuan, and some of these slides are generally what we use for a foreign audience. Then I'll go through the Labuan legislation. I must say that my bias is towards the tax side, although I understand that somebody else is going to talk in more detail about other aspects of the Labuan various legislative codes. I'll touch on some of the non-fiscal incentives. Then I'll run through how Labuan interrelates with various double taxation agreements. Then, at great risk to myself, I'll touch on how goods and service tax works in Labuan. Then I shall run through some of the structures that we've put through Labuan over the last few years, and then maybe finish off with some general points for you to note. Now, I must apologize perhaps for putting this slide up, because I'm sure that you as Malaysians are all very well aware, or at least most of you are Malaysian, all very well aware where Labuan is. But quite often when I talk to foreign audiences, I'm asked questions such as, Labuan? Where is that? As you can see, it's very much a central location within the Southeast Asian region. And I think it's always important to consider the commercial rationale when you're using one of these jurisdictions. Particularly, I'm sure you will have seen in the press over the last few years various attacks on organizations that set up entities in faraway places without any commercial rationale. But I would have thought that where you're setting up a Labuan structure, if you're doing business in this region, that would be part of your commercial rationale as to why you're setting up there. So Labuan, as you can see from the diagram, very centrally located for business in the ASEAN region. In terms of a brief history, Labuan was declared a federal territory in 1984 and became an international financial centre in October 1990. And you'll see much of the legislation dates from 1990. In February 1996, what was then the Labuan Offshore Financial Services Authority, now the Labuan Financial Services Authority, was established as the primary regulatory body for Labuan. And then the Labuan IBFC was established some years later with the objective as being the marketing arm for Labuan. From a general overview, Labuan, through the various pieces of legislation, provides for a number of different types of entity. The most common, at least from my perspective, would be those that fall under the category of Labuan companies. And these can be holding companies, trading companies, banking, insurance, particularly leasing. There are also some specialized entities which offer flexibility, but as a general commercial position, I've not seen an awful lot of companies limited by guarantees. Limited partnerships, limited liability partnerships are still relatively new. Then at the far end on the right-hand side are various entities that I understand are used more for personal wealth management or sort of private client type matters. As I said, Labuan really came into being from a financial or fiscal perspective back in 1990. And so much of the original legislation, Offshore Companies Act 1990, Labuan Offshore Trusts Act, well, it's a bit later, 1996, and then the Labuan Offshore Financial Services Authority Act 1996. And what happened in February 2010 is that a lot of this legislation was essentially remodeled. You'll see that on the left-hand side, the word offshore appears. Now, as time went by, the use of the word offshore became, in some circles, a little undesirable. The OECD had a committee set up dealing with harmful tax practices, and there was a lot of focus on offshore centres. In some of these instances, and this is not a comment directed towards Labuan, but in some of the more obscure offshore financial centres, I think there was a sort of feeling of a little bit out of sight, out of mind. I mean, people weren't necessarily entirely clear as to what was going on. And so in recognition of this, a lot of the Labuan legislation was either redrafted or consolidated, but in either case, the offshore word was dropped. And admittedly, there were some sort of new pieces of legislation, particularly in relation to the enlargement of partnerships as well as foundations. Now, the main focus for today, from my perspective, the real jewel in the crown, is something that was originally known as the Labuan Offshore Business Activity Act, so informally known as LOBATA. And LOBATA was rebranded back in 2010 to become the Labuan Business Activity Tax Act. So LOBATA became LOBATA. And it's LOBATA that provides the real tax basis for the treatment in Labuan. Because the key point is that for qualifying activities, the Income Tax Act 1967 doesn't apply. And instead, for qualifying activities, the tax regime is provided for under the Labuan Business Activity Act. Now, central to the Labuan Business Activity Act is the concept of a Labuan entity carrying on a Labuan business activity. So the key thing is whether the entity is carrying on a Labuan business activity. So that's where you really have to focus. The middle part of my slide, is the definition of a Labuan business activity. And I think a number of you here today are lawyers, so I think it's probably worth looking very carefully at the wording of the Labuan business activity. First of all, a Labuan business activity is either a Labuan trading or a Labuan non-trading activity. So there are two arms to a Labuan business activity, either trading or non-trading. And we'll look at what these mean in a moment. Significantly, the Labuan business activity must be carried on in, from, or through Labuan. I think these are quite wide words, and as far as I'm aware, they're not defined anywhere. The next bit is particularly important. Being carried on in, from, or through Labuan in a currency other than the Malaysian currency by a Labuan entity with a non-resident or with another Labuan entity. So if you focus on these words, currency other than Malaysian currency, so non-ringgit, carried on with either a non-resident of Malaysia or another Labuan entity. So I think what you can see from these is that the primary focus of the LOBATA, the Labuan Business Activity Act, is to apply to what I would describe as out business. That is business that prima facie has nothing to do with Malaysia because it's not in ringgit, it doesn't involve residents, it involves non-residents or another Labuan entity. And this helps a little bit in understanding the philosophy or the jurisprudence behind this piece of legislation. Because on the face of it, why would a government grant tax-friendly legislation to a Malaysian business? It would just be losing money. So the primary focus of Labuan is to attract business that would otherwise not have gone through Labuan. I mean, if I can give you a simple example. I had somebody who came to see me, it was actually a few years ago. This was a Dutch gentleman. And he told me, I want to use Labuan for trading. So I asked him, what are you going to do? Because you can't buy in ringgit, you can't sell in ringgit, you can't deal with residents. He said, what I'm going to do is I'm going to buy furniture, teak, from Indonesia, and I'm going to sell it exclusively to people in the Netherlands. It was just he happened to live in Malaysia and wanted a trading entity to put things through. So if you look at it in that context, that is a perfect example at a simple level of the type of business that Labuan is primarily aimed at. You buy from Indonesians, non-residents, you sell to people in Holland, also non-resident. So that is the underlying concept. But like many things in life, there are exceptions. Particularly, the exceptions are for dealing with residents and for dealings in ringgit. And it's probably the dealings with residents that are more common. You know, for instance, there are a number of banks in Labuan. There are a number of reinsurance companies. And they, quite legitimately, deal with Malaysian businesses and still qualify under the Labuan business activity. So primary focus is what I call out-out business, but with exceptions. So as I mentioned, two types of Labuan business activity: trading and non-trading. And these are relevant for determining the tax treatment under Lobata. A Labuan trading activity, well, it would cover the example I gave you of my Dutchman buying Indonesian furniture. It would also apply to banking, insurance, trade management, licensing, shipping operation, leasing, or any other activity which is not a Labuan non-trading activity. So looking at the other side, a Labuan non-trading activity, really a Labuan non-trading activity is a passive type of activity, an activity relating to the holding of investments in securities, stocks, shares, loans, deposits, or any other properties by a Labuan entity on its own behalf. Sounds as though there's a coffee machine in the background. One thing I would also point out while we're going along, you see that the legislation refers to a Labuan entity. That was also a change back in 2010. As originally drafted, the Labuan legislation referred to offshore companies. But this has now been widened under Lobata, and instead the concept of a Labuan entity is used. And we'll see that in play in a bit more detail later when I run through some practical examples. So you may be wondering, why am I going on about Labuan trading, Labuan non-trading? Well, it flows through to the tax treatment. If you conduct a Labuan trading activity, then you are subject to tax. The rate of tax, however, is 3% of chargeable profits, and broadly chargeable profits are what are shown in the audited accounts. There is an election that can be made. So instead of paying tax at 3%, you can elect and just pay tax at a fixed amount of 20,000 ringgit. I think a point to note here is that although if you have reasonably sized profits, 3% is going to be larger than 20,000 ringgit, some businesses will continue to pay tax at 3% and not elect for the 20,000 ringgit. And that's typically the case where the entities are ultimately owned by a company outside Malaysia. Because in some countries, under their tax legislation, if you pay tax overseas, then the profits are either exempt or the tax is creditable. However, typically such legislation will say that if the tax is just a fixed amount, for example, 20,000, then you either don't get an exemption for that in a foreign country, or you don't get credit for it. So sometimes if you're looking at Labuan companies, maybe doing a due diligence, you will see that the tax that they pay can actually run into millions. And you might think, well, why don't they just elect to pay 20,000? And generally the reason is because they need to do this to maximize the tax position overseas. There's also an opportunity for a Labuan company to elect to be taxed under the Income Tax Act 1967. Now, it might seem rather strange that if you fall under Labata, why would you want to go and elect to be taxed under the Income Tax Act 1967? Well, you may be feeling very philanthropic and feel that you should give lots of money to the government. Alternatively, it could be something to do with double taxation agreements, and I will explain that in later slides, so we learn a little bit at a time. The other side of the Labuan business activity is the non-trading activity. And non-trading activities, the holding, the passive business, they are taxed at a rate of something in the region of kosong, nil, no tax. There may be situations where a company carries on both trading and non-trading activities. And in those cases, you're taxed as if you were carrying on a trading activity, so 3% or 20,000 ringgit. So if I can just summarize at this point, because this idea of a Labuan business activity is key to the legislation. If you're a Labuan non-trading activity, so think of a passive activity, you're not subject to tax. If you're a Labuan trading activity, so think a real business, then you're subject to tax either 3% of your accounting profits, or elect for 20,000 ringgit, or have you elected to be taxed under the Income Tax Act 1967. If you're carrying on both, trading, non-trading, then you're taxed as if you were carrying on a trading. Alternatively, you may elect to be taxed under the Income Tax Act 1967, and I will explain that, why you might want to do that in a minute. You'll appreciate that what I've covered, this idea of a Labuan business activity, that is something created by Malaysia under its tax legislation. So that is the primary legislation. In terms of secondary legislation, a number of tax exemptions have been issued, which are essentially exemptions written by the Minister of Finance at that stage. One of the key exemptions is tax exemption number 22 of 2007. And you will see from this, I don't intend to read it out, but it exempts a lot of the income received by a Labuan company. So dividends are exempt. Dividends received and dividends paid are both not subject to tax. Then there's also exemptions for royalties, distribution from trusts. Interest as well is important. And we'll look at how this exemption might work as I go through some of the practical examples. The next exemption I've put up is particularly important when it comes to leasing. We often see Labuan companies being used in leasing arrangements. Prima facie under Malaysia's domestic law, i.e. the Income Tax Act 1967, when rentals are paid by a Malaysian business to a non-resident, there is a 10% withholding tax. What this particular exemption, the one at the top, does is knock out that withholding tax. And this explains, in part, why Labuan leasing companies are workable. The second exemption order on this slide is essentially for miscellaneous income. A few years ago, a withholding tax obligation was imposed on what is best described as miscellaneous type income paid to non-residents. there's a little bit of confusion as to what the scope of this income is, but it's taxed under paragraph or section 4F of the Income Tax Act. But in the case of Labuan companies, payments from Labuan companies would not be subject to this withholding tax. This point is a little bit theoretical, and I put it there more for completeness. But I think from this slide, perhaps it's the first exemption that is of most interest. There are various exemptions for individuals working in Labuan, and you might want to take the time to read these separately. And they're covered in this slide and the next. The other exemption that we often utilize in relation to Labuan is the exemption from stamp duty. So basically, all instruments executed by a Labuan company, and you'll note the wording here is company, in connection with a Labuan business activity are exempt from stamp duty. So it has to be in connection with a Labuan business activity. So if you were to try and set up a Labuan company to buy your house, that would still be subject to stamp duty, because buying a residential property would not fall within the definition of a Labuan business activity. But where we find this particularly useful is, say, in relation to leasing, particularly, say, aircraft leasing, where the stamp duty otherwise could be pretty high. So this really complements part of the Labuan's drive to become a centre for leasing. In terms of non-fiscal incentives, I understand that there are various eases for expatriates in terms of entry, particularly through the work permit system that they have in Labuan. And also, I think a point to note, but it's become less important nowadays, is that in the past, Labuan was viewed as being outside of Malaysia for exchange control. So in the past, one of the attractions of Labuan was that it offered a considerable degree of flexibility from Malaysian exchange control regime. But nowadays, there's been a considerable relaxation of the exchange control position in Malaysia, and so Labuan companies don't necessarily have a huge advantage in this area. Okay, goods and services tax. How can anyone speak on tax these days without mentioning GST? It seems to be coming everywhere. You walk around one at a time at GST, turn on the radio, GST. Labuan has, at the risk of using bad English, Labuan has a fairly unique position for exchange control, for GST. I say fairly unique, knowing it's bad English, because like Langkawi and Tioman, Labuan is a designated area. So what that means is that although constitutionally Labuan is part of Malaysia, for GST it is treated as being outside Malaysia. Okay, so if you go shopping in Labuan, there should be no GST. So that means that supplies, because the central concept to GST, the Act talks about supplies. I mean, we could talk about sales, but supplies are wider than sales. So sales of things within the island of Labuan are not subject to GST. And consistent with that, if you send goods from Malaysia to Labuan, because Labuan is a designated area outside Malaysia, that's viewed as an export. The other way round, when you send goods from Labuan to Malaysia, that's viewed as an import into Malaysia, so somebody has to pay GST. And I think with services, the position is somewhat similar. Okay, the next point I want to touch on is Labuan and double taxation agreements. Now, you will recall from the slides I was showing you a few minutes ago, I hope you will recall, that I said that basically in Labuan, tax is 3%, 20,000 ringgit, or there's no tax, and there are exemptions from withholding taxes. Okay? So these let's call them fiscal benefits, are provided for under Malaysia's domestic legislation. So they are quite independent of double taxation agreements. You do not need double taxation agreements to obtain these type of benefits. You just have to be carrying on a Labuan business activity. Okay? However, there are situations where it is relevant to look at Malaysia's double taxation agreements. For instance, imagine a situation where a Labuan company holds an investment in an Indonesian subsidiary. Now, prima facie, that fulfills the requirement of a Labuan business activity because you are a Labuan company owning shares in an Indonesian company. That Indonesian company is highly unlikely to be a resident of Malaysia. So you can tick the box there, and if all you're doing is a passive holding activity, you would not be subject to tax in Malaysia. But your investment is an Indonesian subsidiary. That Indonesian subsidiary will presumably, you hope, pay dividends from Indonesia. When it pays dividends, those dividends are subject to withholding tax under Indonesian law, not Malaysian law, Indonesian law. Now, as I understand it, the domestic rate of withholding tax in Indonesia is something around 20%. But if you look at the Indonesia-Malaysia double tax agreement, that rate of withholding tax is reduced to 10%. So if you are a Labuan company, you will be pretty keen on being able to access that reduced rate of withholding tax pursuant to the tax agreements that Malaysia has signed. Okay? So that is how double taxation agreements come into the picture. Now, what some countries have said, if I can read my faint writing, Australia, Chile, Indonesia, Japan, Korea, Luxembourg, Netherlands, Seychelles, South Africa, Sweden, the UK, and Germany. These countries have said that if you are a Labuan company governed by the Labuan Business Activity Tax Act, you cannot access the benefits under the treaty. So obviously your tax position under Labata remains. Indonesia or whatever country cannot disturb that because that's domestic legislation. But what they can say is, we're not going to allow you to enjoy fully the treaty benefits. Okay? So this is how the double taxation agreements apply and why they need to be looked at. Now, in an attempt to create a more relaxed environment, what happened? A provision was made that allows Labuan companies to elect to be taxed under the Income Tax Act 1967. And the idea is that, or the hope is, that foreign governments will accept that those Labuan companies that make such an election will be entitled to treaty benefits. Okay? Does that make sense? I hope it does. Now, this provision has been around for probably about 6 years now, 5 or 6 years. I understand that the governments of India and Germany have said that if a Labuan company elects to be taxed under the Income Tax Act 1967, then they will allow treaty benefits, assuming that you meet all the conditions for obtaining the treaty benefits. So you would not be denied those because of the fact that you've elected to go under the Income Tax Act 1967. And I think another important point to note is that under the Income Tax Act 1967, foreign source income, so for instance dividends from a German company, foreign source income is exempt from income tax in Malaysia, unless you, the recipient, are carrying on the business of banking, insurance, shipping, or air transportation. Okay? So I mentioned to you a few slides ago that I would explain why Labuan companies might want to elect to be taxed under the Income Tax Act 1967. So that's the reason, and it's not as daft as it might otherwise sound. As I said, it's important to remember that the benefits granted under Lobata or under the various exemption orders, those apply irrespective of double taxation agreements. Those are granted by the government of Malaysia. Okay? It's more looking at the tax coming out of the foreign country. Then you have to start looking at double tax agreements.
Excuse me. What if I invest in a US stock?
Yep.
And I get, more than 10% dividend, but the US government charges 30% withholding tax on the dividend income.
Yeah.
The Labuan company, the whole US stock. How to maximize the tax?
That's always a problem with the US. Malaysia doesn't have a comprehensive tax agreement with the US. All Malaysia's tax agreement with the US covers is basically international transport. So shipping profits, airline profits. So yes, if you're a Malaysian investing in US securities, then US taxes are going to be a cost to you. What I thought I would try and do, that's the sort of theoretical part. Perhaps I can illustrate some of these concepts by running through this list of examples. I should give the usual sort of health warning that these are outline concepts. If you try to do it at home, it's your own risk, that type of thing. So don't blame me if you get hurt. These are just, but what I really want to illustrate is how double taxation agreements interact and the distinction between trading and non-trading activity and the ability to deal with Malaysian residents. Let me start first of all with a Labuan holding company. And here I'm looking at a situation where the Labuan holding company is going to make investments overseas. I would remind you that if you are setting up a holding company, in this day and age, particularly in view of all the stuff coming out of the OECD about BEPS, the base erosion profit shift, I think you really must think, what is the commercial rationale for setting up a holding company? But there's no reason, in principle, why you should not be able to set up a Labuan holding company to hold your overseas investment. The income from that overseas investment would be viewed as a non-trading activity from a Malaysian perspective, and therefore, under Lobata, it would be subject to tax at nil, yeah? Because it's non-trading. It's a passive holding activity. Depending where that foreign investment is, you need to consider whether there are treaty benefits that you need to access, both in terms of withholding taxes on dividends and in terms of exit strategies. So let us say that your Labuan holding company itself is owned by a foreign parent. When the Labuan holding company, yes?
Sorry, can I just ask a question? In terms of holding company, say someone wants to buy an asset in the UK, are you saying that for the purpose of tax, it would be better to hold the UK asset under a Labuan company rather than a Malaysian company?
No, I'm not saying that. What I'm saying is that if you hold it under a Labuan company, there is no tax in Labuan. You need to consider what is the UK position as well. Because when you're holding an overseas investment, there are always going to be taxes at several levels. You have to look at the UK. What country is best to hold a UK property? Do you do it through a Labuan company, a mainland Malaysian company? Should you hold it in your own name? Should you use a Jersey company? So you always have to when I do international structures, I always think you have to start off at the bottom and work your way up. So the purpose of these is not to give you a recommendation that for going to the UK you should use a Labuan company. The purpose of these diagrams are just to sort of show you how Labuan works, and perhaps on a larger sort of position to give you what the thought process should be in terms of you should start at the bottom, the UK, and then work your way up. So in the context of a Labuan holding company, dividends paid to the shareholders are also tax-free. An area where we see Labuan used a lot is for leasing. I've seen this used on a number of occasions, particularly for aircraft, as well as ships and vessels used in the oil industry. And I think that leasing is one of the activities that Labuan is actively targeting. There is a requirement that leasing companies must be approved. So the approval would be through the LFSA, which is the regulator. So Labuan is quite a regulated environment. It's not one of these free-for-all overseas environments. Leasing must be on a bare boat basis. That is, you just rent or lease the asset. It cannot be with crew. It's one of LUFSA's requirements. Using my simple structure, just to illustrate how Labuan would work, you imagine a situation where the aircraft is owned by a foreign party, a foreign lessor. So what that foreign lessor could do is grant a lease of the aircraft to the approved or licensed Labuan leasing company. That Labuan leasing company, having been approved by LUFSA, would then sublease the aircraft to a Malaysian business. Now, from a tax perspective, provided the Labuan company is tax resident in Malaysia, lease rentals paid from one Malaysian business to another Malaysian business would not be subject to withholding tax, because withholding taxes apply when you're paying to a non-resident. It would be appropriate to consider the need for obtaining a certificate of tax residence for the Labuan company. Now, when the Labuan company pays lease rentals under its lease to the foreign lessor, there is an exemption from Malaysian withholding tax. So lease rentals from the Labuan company to the foreign lessor would not attract withholding tax. So this is quite a useful structure. The Labuan company would be carrying on a Labuan trading activity. So it's an active business and therefore subject to tax at 3% or the election for 20,000 ringgit. And as I mentioned earlier, there is a stamp duty exemption for documents executed in connection with a Labuan business activity. And that, again, is a useful exemption to have in the context of a leasing arrangement. Another situation where we sometimes see Labuan companies is as a vehicle excuse me, to raise finance. So imagine somebody wants to raise finance from international markets. Prima facie, when you pay interest, when you, a Malaysian business, pay interest to a non-resident, there is a 15% withholding tax cost. It's possible, with the correct approvals, to structure the fundraising activity through a Labuan finance company. So the Labuan finance company is established, the non-resident makes the loan to the Labuan finance company, which in turn makes the loan to the Malaysian business. provided the Labuan company is Malaysian resident. When the Malaysian business pays interest, there is no withholding tax because it's a payment from one resident to another. When the Labuan finance company pays interest to the non-resident, that is exempted from withholding tax pursuant to a specific exemption. Now, there are various controls. In particular, the Labuan company, if it is not going to pay tax on that interest, then it must get approval from the Minister of Finance. But we have seen these used in a number of large bond-raising activities. And this also provides an example of Labuan companies being able to deal with Malaysian residents. Okay, Labuan Trading Company, not necessarily so common because of the restriction on dealing with residents. Because of this restriction or prohibition on dealing with residents, it means that a trading company cannot buy stock or things from residents and cannot sell. But as I mentioned at the start, my example of a Dutchman setting up a Labuan company to buy teak furniture from Indonesia to sell exclusively to the Netherlands would be an example of a situation where you can set up a Labuan company to run this business through, and something that makes sense. Now, there are some particular points to note with the use of Labuan. I go back to the definition that a Labuan business activity must be carried on in, from, or through Labuan in a currency other than ringgit by a Labuan entity with non-residents or with another Labuan entity. There are some provisos to that statutory restriction. In relation to a Labuan entity carrying on business under LFSSA or LIFSA, this is basically looking at financial business. So this is banks and reinsurance companies. In those cases, such activity may be carried on with residents and, where permitted, may be carried on in ringgit. So that's why you see transactions occurring in the domestic market, but involving typically a Labuan bank. In relation to the holding of investments by a Labuan entity, Labuan entities can hold investments in Malaysian companies nowadays, and consequently these can be in ringgit. In relation to the holding of debt obligations, so this C is applying to this conventional financing type arrangement. So in relation to the holding of debt obligations, i.e. loans, such holding may be in ringgit, okay? But this is all subject to paragraph F, which I'll flick to in a minute. Sorry, I seem to have lost paragraph F. Basically, subparagraph F says that for loans, for debt obligation, for that to qualify as a Labuan business activity, when a Labuan company makes a loan to a domestic company, it's necessary to get approval from the Minister of Finance. So this is a good example of one of the controls in Labuan. Although Labuan is a tax-friendly environment, it is controlled. Well, that brings me to the end of my slides. I hope that I've not confused you, and I hope on a more positive side, on a more positive note, that I've managed to give you some idea of how the Labuan tax legislation works, as well as some practical examples. Thank you for your attention.